Hello, I'm David and I want to welcome you to another one of my videos for helping entrepreneurs who want to start their own business and to be successful and in the process have a lot of fun. This video has lots of content, so I'm going to try and keep it as short as I can. Very quickly, background to this video. I receive a lot of visitors from the United States of America and in the UK who want to start their own business, and they obviously are interested in information like how to register the business name. So I have put this video and similar videos to help them, and hopefully it will help you as well if you are interested in starting your own business. In this video I'm going to cover different types of companies, including their pros and cons in respect of three types of companies: limited liability partnership, corporation, and the S corporations. Now before I start, just to let you know that I am not a lawyer. I am a CPA. I'm a qualified accountant or a CPA, and I do start businesses. I've started many. I've also helped owners of small businesses to run successful businesses. But one thing I do not do is give legal advice, because I am not a lawyer. If you want legal advice, then you should engage a lawyer, or in the UK call them a solicitor. Okay, let's continue. We start off with limited liability partnership. Limited liability partnership is like a general partnership without personal liability. It was devised to allow partnerships to limit their personal liability without losing their partnership structure. This was important because converting to an LLC could have tax consequences, and some states do not allow professionals to operate as LLCs. Both general and limited partnerships can register as LLPs. Now, the advantages of limited liability partnership. The limited liability partnership offers the flexibility and tax benefits of a partnership with the protection from liability of a corporation. The disadvantages of limited liability partnership: a startup and annual fees are higher than for a corporation. Also, the law requires the partnership to maintain certain minimum insurance. Now I'm going to turn to the corporation. A corporation is an entity that's legally separate from its owners. Its distinguishing features include limited liability, easy transfer of ownership, unlimited life, the ability to raise large sums of capital. A corporation, like an LLC, is a statutory creature created and regulated by state law. In short, if you want the privileges, that's what the courts call it, of turning your business enterprise into a corporation, you must follow the requirements of your state's Business Corporation Law or Business Corporation Act. Short for that is BCA. What sets the corporation apart in a theoretical sense from all other types of businesses? It is a legal and tax entity separate from any of the people who own, control, manage, or operate it. Federal and state laws view the corporation as a legal person, which means that the corporation can enter into its own contracts, incur its own debts, and pay its own taxes separate and apart from its owners. For tax purposes, there are two types of corporations: C corporations and S corporations. A C corporation is just another name for a regular for-profit corporation. A corporation taxed under normal corporate income tax rules. The letter C comes from subchapter C of the Internal Revenue Code and is used to distinguish these regular corporations from S corporations, a more specialized type of corporation that is regulated under subchapter S of the Internal Revenue Code. Now this section covers the more common and widely accepted C corporation. S corporations are discussed in more detail below. A S corporation gets the pass-through tax treatment of a partnership, which is with some important technical differences, and the limited liability of a corporation, much like an LLC. This section covers the more common and widely accepted C corporation, as the S corporations are discussed in more detail below. To form a corporation, you pay corporate filing fees and prepare and file formal organizational papers, usually called articles of incorporation, with a state agency. In most states, this Secretary of Department of State. Once formed, the corporation assumes an independent legal life separate from its owners. This separate legal life leads to a number of familiar traditional corporate characteristics discussed below. The advantages of corporation: limited liability for shareholders. A corporation provides all of its owners, that is the shareholders, with the benefits of limited personal liability protection. If a court judgment is entered into the corporation, or the corporation can't pay its bill, the shareholders stand to lose only the money that they've invested. Creditors cannot go after the personal assets of the shareholders. The main reason why business owners decide to form corporations is to avoid personal exposure to business debts and claims. Now let's look at paying taxes. To understand corporate taxation, you need to know how unincorporated businesses are taxed. In an unincorporated business, the owners pay individual income taxes on all net profits of the business, regardless of how much they actually receive each year. For example, assume that a partnership or an LLC has two owners and earns $100,000 in net profit. If the owners split profits equally, each must report and pay individual income taxes on $50,000 of business profits. This is true even if all of the profits are kept in the business checking account to meet upcoming business expenses rather than paid out to the owners. Shareholders who work for the corporation are paid a share of the profits as employees who receive salaries for their work in the business. The corporation deducts these salaries as a business expense when it computes its net taxable income, but because the owners of a small corporation also manage the business as its directors, they have the luxury of deciding how much to pay themselves in salary. This allows the owners to decide how much of the profits will be taxed at the corporate level or paid out to them and taxed at their individual return. Now, two results follow from this. First one, corporate owners only pay individual income taxes on salary amounts they actually receive, not on all the net profits of the business, and in the second instance, the corporation pays corporate taxes on the net profits actually retained in the business, that is, profits that remain after paying normal business expenses, including the salaries paid to the working owners. The corporate tax scheme taxes the business on profits actually retained in the corporation, while taxing the owners only on profits they actually receive. This type of income splitting between the company and the owners can lead to tax savings, at least for small corporations. The corporation's owners file individual income tax returns and pay taxes at their individual tax rates on the salaries and any bonuses they receive. At the end of the year, the corporation files a corporate tax return, IRS Form 1120, corporate income tax return, and pays its own income taxes on the profits left in the company. Corporate tax rates are normally lower than shareholders' individual tax rates for the first $75,000 of income. Currently 15% for the first $50,000 and 25% for the next $25,000. By the time you come to watch this video, the rates might have changed, so it's important for you to check the IRS website to find out what the relevant rates are. This means that if the owners decide to retain profits in the business for expansion or other business needs, profits of up to $75,000 will be taxed at the rates that are typically lower than the owner's individual tax rates, resulting in overall tax savings. Now we turn to the S corporations. An S corporation is a corporation that qualifies for special tax treatment under the Internal Revenue Code and state corporate tax statutes as well. To form one, you'll have to jump through the same state incorporation hoops as you would to form a regular C corporation. This means you have to file articles of incorporation with the state and pay a state filing fee. Then to select S corporation tax treatment, the shareholders must sign and file an S corporation tax election, IRS Form 2253, and possibly a separate tax election with the state tax agency. But as well, you see below, choosing S corporation status is a tax, not a legal election. The same legal corporation rules applies to C corporations, also apply to S corporation.